Welcome everybody to the November Contemplating Your Exit webinar. This continuing series has been developed to help buyers and sellers best equip themselves when the time is right to either exit or to purchase a business. Super excited today to have a good friend and colleague, Jeff Heybruck, on with us today to talk about getting your finances in order. So Jeff, you want to give a brief background about yourself and we'll jump in.
Sure. Thank you very much for having me, Adam. My name is Jeff Heybruck. I've been doing Lucrum Consulting. We started in 2010, so it's been about 12 years now. We offer basically outsourced accounting services to our clients. We don't do any tax or audit. A lot of people confuse us with their friendly CPA. We focus more on the bookkeeping and CFO level services. Before that, I was a CFO of a land development company for about 5 years. So I learned the real estate and construction business. And then I also did 5 years in public accounting to start my career.
Great. And my name's Adam Petrov. I'm the managing partner of VR Mergers and Acquisitions here in Charlotte. We've been in this market for over 20 years, helping small, medium, and large companies exit when the time is right. Today is a really important topic that I'm super excited to have Jeff here. It all is about getting your finances in order. And it's not snapping your fingers, as Jeff is going to get into here. So before we get in, I do want to give a disclaimer that everything you hear, Jeff is not giving specific financial advice. This is informational, but these concepts do apply to both small, medium, and large businesses equally. So I had to get that disclaimer out of the way. My attorney prefers that I have that in there. So Jeff, I'm going to cue this up and let you go from here. The subject of this title of this slide is why numbers matter, and I'm going to let you go from here, and you're encouraged, if you're watching, to ask any questions in the Q&A section. I'll be happy to integrate them. Feel free to fire away at any time and I'll manage that. But Jeff, let's talk about why numbers matter.
Sure, thank you, Adam. So obviously the first point there is it'd be heresy for an accountant to say that numbers don't matter and that trends are more important. But what you have to consider is if you take two businesses with identical numbers, one's been shrinking for the past 3 years, and the other one is reporting somewhere in the 15 to 25% growth, which one would you pay more for? So the point I'm trying to make is that numbers are important, but trends often tell a bigger story. Obviously, as accountants, we're valuing a business based on the numbers that the business puts up. Adam is helping his clients sell a business based on the numbers they're reporting. You're going to buy based on the numbers you see, but it's important to look behind the numbers and figure out what's causing them. Same situation, different example. What if you have a smaller revenue business, but they have a trend of getting higher margins consistently? Which would you pay more for? Business with higher margins that you can scale, or a business with more revenue but has lower margins? Okay, I don't think that's earth-shattering to anybody. Accuracy, of course, is important. If you have supporting documentation, it needs to tie. It needs to support what's in your financial data, not conflict with it. We see people with Excel schedules, checkbook or other kind of registers, their CRM software, maybe a point of sale software, maybe a warehouse shipping software that doesn't match up. If the financials don't match the tax return and don't match the, if the supporting detail won't match the tax return or won't match the financials, you better be able to explain it. The buyer is going to ask for information. If your financials don't match your tax return, you better be able to explain why. The buyer, any savvy buyer, any smart buyer is going to ask for transcripts. They're not going to trust that the numbers on your tax return that you are sending them is what you actually filed with the IRS. They will, I think it's a 4506, they're going to get that signed and they're going to send that to the IRS and verify that what you're giving them on the tax returns is what the IRS has on the file. So what we tell folks here is when in doubt, use third-party prepared documents, not the ones that you prepare yourself. Third-party prepared documents is something from the bank. What would you trust more? A document that I or an internal accountant with the company prepared to show the amortization of the loan, or an actual loan statement from the bank? You're obviously going to trust the bank information a lot more. So try to find things that maybe if you're buying a franchise, use the sales reports that are coming directly out of the point of sale system that is required by the franchisor. that is probably more trustworthy than what they might have in QuickBooks or some Excel schedules that the owner might put together. This is another one, point number 3 that we see a lot is, congrats, you saved on taxes and you didn't give Uncle Sam his fair share of that sale. That's great. But now you're going to give it back with a lower EBITDA number. They simply don't count. I don't care how much you say, well, I have 10,000, 100,000 in cash sales. It's a 0. Whenever you're doing this, if you're looking to sell your business and you do engage in some cash sales, we're not here to judge people, but keep in mind that your sales price is usually a multiple of the EBITDA. So if you're getting a 2 or 3 multiple of EBITDA, that $100 that you didn't report or $1,000 you didn't report as a $2,000 or $3,000 effect on your sales price. I'm generalizing. Adam might want to be tell me to shut up here, but keep in mind that's really going to hurt your impact. You got to think about it might be worth reporting all sales and waiting a couple years to have all of the sales tracked versus going back and trying to figure out how much cash you put in your pocket. For those of you that don't have cash sales in your business, you're probably shaking your heads, but we see it quite often. Adam, am I right?
All the time, yes. I just want to add one thing here just to clarify. Jeff uses the term Ebitda, which stands for earnings before interest, tax, depreciation, and amortization. And that is one metric. The other is seller's discretionary earnings, or it's a version of adjusted Ebitda where we can add back one owner's salary, discretionary spending, etc. But in essence, it's the same. It's the cash flow that the business is generating. So go ahead, Jeff.
Right, absolutely. Obviously, when you're buying a business, you're going to focus on what the business has done, the financial aspects, but that's the historical results. No one buys a business based on the past. They're going to buy it based on the future. So to do that, most people will look at some forecasts and come up with their own, take what the business owner gives them. We encourage folks to be skeptical of those. Anyone can forecast growth and predict wonderful things. We encourage folks to find the previous budgets, find previous forecasts, and then compare them to actual results for the past. How often do they hit or miss them? By what percentage do they hit or miss? This is going to help you determine how much faith to put into the current year forecasts. Also, too, are they even realistic? We've seen clients that have their BHAG, big, hairy, audacious goal, and they want to be, a $30 million company, and they're sitting at 3 or 4 right now. I don't think you're going to take a $5 million company that's a traditional business, not one of these, easily scalable tech businesses, and go from 3 or 4 million to 30 in 4.5 years. It just seems unrealistic to me. If somebody's got a $300,000 average monthly revenue number and their forecast for next 6 months is calling for 600 a month, you got to really think, is that realistic? And am I going to rely on this forecast, or I need to maybe move that back down to 400 and reforecast those numbers and help decide how much I think this business is worth and what I should pay for it. The same thing when you're trying to value it. It's really hard to value what you haven't done. And then lastly, look behind the numbers, look between the numbers. A lot of value isn't on the financials as a number. There's people, processes, procedures, industry niche, goodwill, the amount of website traffic they have, name recognition, things like the age and the quality of their equipment. Can the owner easily be replaced, or do all the relationships lie with him? Let's talk about revenue. How much is recurring versus one-off revenue? Are there key people that are essential to the business? What's the secret recipe? That's the kind of stuff that we really need to look at and value in the business that is not going to be easily seen on the financials. It all gets rolled up in the accounting term goodwill, but most people don't understand what that really means. So it's look behind the numbers and try and figure out what makes those numbers there. We had a great example of looking behind the numbers. Adam and I were involved on a transaction where a gentleman was selling a massage franchise. They had millions in gift card liability and membership liability, like prepaid membership or unredeemed memberships, and of course, unredeemed gift cards. I think everyone understands the gift card model. The buyer that they ended up going with correctly understood that to satisfy that dollar of liability did not require a dollar of cash. That was a sticking point with a couple other people that were looking to buy that were not sophisticated and were not familiar with the model. If you think about it, you have a $100 gift card for a massage. What is the true cost of that? Well, it's the therapist's time and maybe some minor consumables and some maintenance of the sheets, turning the sheets over, so a cleaning bill. the buyer realized it took somewhere around 40 to 45 cents to satisfy every dollar of liability. That's the kind of thing I'm talking about. Get behind the numbers and understand what the numbers mean and how they'll affect you if you buy it and move on.
This is really great, Jeff. I mean, that you said a lot there. So I did get a question already, and you know, well, one of the things that we see is, you know, when we're talking with business owners, they hand us the P&Ls and the tax returns, and quickly we realize they don't always match. Sometimes it's because it's accrual versus cash, et cetera, but sometimes they flat out just don't match. And you and I recently had a situation like this. So for a business owner, if they know they need some work, maybe they're preparing it, their financials internally, they don't use an outsourced service like yourself. If they need some help before they're getting ready to go, how long, I know in general, and you can give a range, how long would it take for a firm like yourself or others that do what you do, outsource, you know, bookkeeping services, to sort of get them ready to clean up the books and get them ready to go through the process of selling a business?
It's a great question. One of the things that you have to look at is what are the condition of the books. So the exact answer I'm going to give you is it depends. So let me give you a couple examples on there. There's a good reason why your numbers might not match your tax returns, and it could be simple as maybe the bookkeeper on staff hasn't been booking the adjusting journal entries that the accountant, the CPA might be giving at year end, things to record depreciation, correct for gain or loss and sale of equipment. That's very common. Some CPAs don't give them unless they're prompted. Some folks get them and they don't really know what to do with them. They just kind of throw them in the drawer as part of the tax return. Heck, we make mistakes too. Sometimes we just forget to book them and we catch it next year and we get the 2 years caught up. That could be as little as an hour to get that cleaned up. And now the tax return and the financials are going to tie perfectly. You get to the other end of the spectrum where you get maybe somebody that's not qualified. It's maybe somebody's family member or the business owner is doing it themselves, and running the business or sales is always going to take precedent over sitting down and pounding out the mind-numbing accounting. Those are going to take a little longer and it's hard to give an estimate for. I wouldn't say anything less than a month. It could be up to maybe 2 or 3. We've done some recent engagements where it took us about 3 months to get caught up. This is for an operating business, not someone looking to sell, but they hadn't done much accounting from, say, April, May timeframe. And we had to get them caught up through September, October, and had a fair amount of transactions. So that took about 2 to 3 months to really get started. The first month was kind of get started up. The second month was hot and heavy. And the third month was kind of finishing questions and kind of putting a bow on it. And now we're back to more of a maintenance level.
Okay.
So that's probably the most recent.
So an hour to 3 months. I like the range. And it depends. You did qualify that. So let's move on to the next slide here. Let's talk, you're a big fan of making little changes and having really big impacts. So I'll let you jump in here.
This is something that when we were preparing this, Adam, I brought this up. This is a bigger presentation we do called the 3% solution. And the disclaimer here is 3%. Well, yeah, if 3% is good, is not 5% better? What about 2%? Yeah, it's kind of irrelevant. Pick a percent and go with it. We like 3 because it's more than 2 and less than 4. It's just a good number. So we all understand that compound interest has a big impact on our retirement plans and our bank accounts over time. We understand that forest fires are caused by a little spark or a little campfire that got out of hand. We can apply that same concept to our business. So real quickly, to boil it down, we want to increase revenue, we want to keep cost of goods sold flat, and we want to decrease our administrative and overhead expenses by all the same 3%. Well, it's easy for me as a consultant to say, well, just go sell more. Just go sell 3% more. That's easy. Well, I'm not talking about adding new customers. I'm going to look at ways to sell to more existing customers, kind of while you're already there. The cleaning industry, the carpet cleaning industry has this down to a science. They're cleaning your carpet for that one-room deal. They upsell you to clean your couch, maybe your draperies, maybe steam clean the cloth seats that your kids have spilled chicken nuggets and French fries on for the years. All of that is very high value services to the client, but it's also very high profit to the person doing the work, the business doing the work. They're already there. They've already spent the money to drive to your location and get set up. We have a client that is a paving general contractor, and they came up with a report that while they're already doing a quote, they take the extra time to do a analysis of the entire paving asset that the client has, not just with the patch or the area they're asked to fix. Then they can come back later on and they can try to upsell the client with providing them that report to give them a budget if they're asked. A lot of times they don't need it, but if they can sell that, it only took them an extra 30 to 45 minutes generally to do that report, maybe in a 30 minutes in the office to put it together, and they have it. So they do that for every client now. And a lot of times they can sell it, and it's a huge generator, additional revenue generator at zero marginal cost. Other ideas are follow through on estimates and quotes. You've already given the quote. It'd be great if you could just collect the order and ship the product or perform the service. Follow up on a lot of those that just go in never, never land. And then simply put two, be thorough. A lot of home builders have change orders. You might upgrade your granite from level 1 granite to level 3. Well, if you don't have a process to catch that, you're still going to charge the client the original amount. Well, the customer owes you for that. You've paid the supplier for the higher cost granite. Go ahead and collect the extra revenue. That's an easy way, a couple of easy ways you can get that extra 3% we're looking at. Now we want to keep cost of goods sold flat. So we're going to look for labor efficiencies. We're going to look for ways to do work more efficiently and do our best to reduce the cost of supplies. I know that sounds like heresy in an area with a tight labor market and a lot of shipping and logistical delays. But the best things we can find is decreased waste. Plan ahead, communicate well with your suppliers, communicate well with your customers and your clients, and make sure that you're not letting folks milk the clock and you're holding people to their bids and to their quotes is the best way we can have seen our clients implement that. And then lastly, cutting the overhead literally just puts dollars in your pocket. You've already brought in the revenue, you've already performed the work. This is just money that's just being frittered away. Our goal here is to cut it by 3%. A lot of times we see clients cutting their XM radio now. I know that might sound like heresy to some folks that are big sports fans or have niche listening, but Amazon Music, a lot of us have Prime membership. Find a station on Amazon that you can listen to. Scrub your cell phone bill. We've seen folks have phones still on the plan, still alive, that they know they left in the airport, or hotspots that they don't use, or people that got fired that took the phone with them and threw it in the river out of spite. Go ahead and cancel it. Just take the time and scrub it maybe once a quarter. Look at your copier bill. Our copier bill at Lucrum was going up 7.5% a year. That's ridiculous. So I beat them down, got them to 3.5% or 4%. We see a lot of folks with storage units they're paying for just because they don't want to take the time to go empty it out. Just a lot of waste. It's pretty easy to do. If we go to the next slide, Adam, you can see the
Well, I just want to ask, Jeff, I mean, you touched on it briefly. I mean, we're clearly in an inflationary time with supply chain issues all over the world right now. And, you know, just in time right now, maybe 4 to 12 weeks for an industry. And so what are you advising your clients to, you know, obviously the goal would be to keep cost of goods, you know, flat, but, you know, flat may not be possible. So what are you doing to try to, other than stamp out waste, what other options are you providing to your clients in this category?
Well, we're giving kind of advice that we hate to give because we think the advice we're giving is part of the problem. We're telling folks to plan ahead and order early so that it's there when they need it, especially the folks with good cash flow. That is part of the problem, though, is no one has confidence in the supply chain, so they're ordering things earlier than they need it, which impacts an already stressed system. And we all remember what a year or two ago people were buying 5 and 6 bundles of toilet paper when at most they were going to use 1 or 2 in the next 6 months. So that stresses the system more, but our interest is in helping our clients. We're also trying to tell folks to come up with unique things. If you can't deliver what the client needs and you need that specific item, are there different substitutes you can use? Try and plan ahead. We have builders that say, well, this material is in very short supply and I'm struggling to get it. Can we substitute for something else that they might be able to get and do, maybe instead of doing the real pretty accent wall now, we kind of take that out and you just maybe call us back in a year and we'll do it for you for less. We're just going to do normal drywall now to get through it. And you can't get this special glass or you can't get this special wood finish from Brazil or wherever you're trying to do.
Yeah.
So a lot of folks are trying to do workarounds to get the overall project done, and with the idea being 80-85% of the whole thing is better than sitting there with a gap and an empty unfinished project.
So let's take that 3% and move that on and show what that actually does. You there, Jeff? Did I lose you? This has never happened before. Jeff, is
yeah, I'm here. I'm waiting for the
Okay.
slide to change. I haven't seen the slide change yet.
It has changed.
There we go. Okay. Sorry about that.
Yep, no problem. Go ahead.
All right. So before you see, we're a $2 million business. we good now?
Yep, we're good.
Okay. All right, I'll start over. So before we were a $2 million business in revenue, we were only at 5% of the bottom line, a little lower than we'd like for the profit. But after the 3% solution, we've generated about $2,060,000 in revenue. You can see we've kept our cost of goods sold flat. Our gross profits up to 27% from 25. Our overhead expenses have gone down the 12,000 we talked about, 3% of 400,000. And you see the effect on the bottom line. And 8% versus 5%, we've increased our bottom line 72 grand. If we're talking about a multiple of Ebitda, and I know this is a very simple solution, Adam might disagree with the simplistic nature of it, but just for the illustration, if a business is 2 to 3 times their Ebitda, they're looking at about $200,000 or $300,000 sales price. If we're looking at after the 3% solution, 2 to 3 times, it's roughly $350,000 to $500,000. Which business would you rather be selling? All for making a couple 3% changes.
It's great. It's great stuff. So time to sell. Now what? Walk me through this.
All right. We're going to use the metaphor here of selling a house. I figure a lot of people on this podcast or this webinar have probably done either bought their own house or sold a house or maybe done it multiple times. So it's a lot like selling a house. Get someone to do pre-due diligence or pre-diligence, whatever you want to call it, on your business. This is very similar to getting your house inspected before you sell it. I'm not talking about an audit. Don't go to your CPA and get an audit, but definitely want your financials as clean as possible. Get someone who's trained in due diligence to do the same thing on your company and give you that recommendation. Now you can take those steps and get that done ahead of time so that you have clean financials and it's already been, scrubbed already prior to taking your your financials to market. Do things that you can, little things that you can to maximize your gross profit. Refer back to the last 2 slides. Little change, big impact. Focus on the small things, knowing you're getting a 3 times multiple return. Gross profit is the #1 driver of profitability and cash flow. So the buyer's going to spend an inordinate amount of time looking at that. Make sure it's as clean as possible. If you're doing job costing, make sure you have everything allocated to jobs so that you have your revenue and cost of goods sold set by customer. You can look at your profit by customer, and as much as possible, that the sum of all the profit by customer or profit by project ties to the total. That's going to really make a buyer feel comfortable knowing that your margins are solid and they can be relied on. Too many folks tend to gamble or want to get the big score, knowing they got that 2 or 3 times the multiple coming in that year they're going to sell. We advise against that. Stick to what got you there. Stay in your lane. Don't get fooled into rolling the dice or looking to make that home run, grand slam to win the World Series and do the bat flip. Just stay in your lane. The problem is you don't have time. If you're looking to sell and something backfires or the rolling out the new division, the new line takes longer than you thought, it's sucking up cash. It's going to actually hurt your business and you don't have time to get it turned around if you're looking to sell on a short-term horizon. This is really important too. Pay a lot of tax when you're going to sell. Minimize the questionable, aggressive, or the quote owner expenses. If your son or daughter are working in the business and you're paying them 30, 40 grand a year to clean or sleep on the couch, stop it, get it out. I know Adam says you can add it back, but the cleaner it is, the better. The less add backs you have, the better. Make it simple for the buyer. The year or 2 before you sell the business should be the most tax you ever paid, if possible. Some folks sell in a down market. I understand that, but just keep that kind of mindset. I want to pay the most tax the year before I sell because I was the most profitable and I had the least expenses. I was as lean as possible.
I got to interject here, Jeff. I'm curious because I have this conversation as well as you do, but any success you have in looking your clients in the eye and tell them, really, you need to pay more taxes this year and next year. You're going to get it back. I mean, we tell people, we do the math. Every dollar you're paying for tax, you're going to get back in 2, 3, 4 multiples. But do you have any secret line that I could steal that is helpful in persuading sellers to put everything in and pay more taxes 1 or 2 years ahead of going to market?
I don't. I literally just show them the math. I just say, this couple $1,000s of deduction, and yeah, you're a landscaping business and put all these nice bushes in your house. We're going to pull that out. We're going to take that as a distribution so it doesn't impact the gross profit. I understand you buried stuff like that, your koi pond and the bridge you built, in the backyard, all that's wonderful in the past, but we can't do that now because that $10,000 project is going to cost you 30. Is that worth it? And they really get wide-eyed. The problem is a lot of them have gone to a seminar or a webinar, or somebody's told them that, oh, well, we can just add all that back. And that's the uphill battle I have, is trying to get them to not believe in the add backs and just focus on making things clean. They want
banks will limit the amount of add backs. If you see a company that's, I'm making numbers up, that's got $500,000 of seller's discretionary earnings, but 200 or 250 of that's add backs, the lender is going to be uncomfortable. That's too much. It's too high of a percentage. Typically, they want it in single digits or low double digits. Now, every business is different and every lender is different. But if you abuse it, you also run the risk of having your business not be lendable. So it's another reason to clean up your financials.
When we're on the buyer side, when we see that kind of huge add backs, we look and say, how ethical is this guy? If he's going to steal from Uncle Sam and he's going to do that, can we trust him? I mean, no one likes paying taxes, but at some point, you made the money, you got to ante up.
Yep. And last bullet point.
All right, last couple things. Yeah, last couple points. So we just talked about minimize add backs. We're going to make it clean. Again, when you're selling a house, your realtor is going to tell you to declutter. I understand this collection you have in the corner might be beautiful to you, but people don't want to see all the clutter of all the teddy bears or your jerseys and stuff hanging out there, trophies and whatnot. Get all the junk out. Same thing though, clean up the yard where the equipment's stored, clean up the warehouse, clean up the office, clean up the books. The cleaner things look, the more impression you're giving, right? It's put a coat of paint on the porch, that kind of thing. Just do the window dressing. Give the best first impression, like your mom said. Put your best foot forward. And then lastly, it kind of goes in the stay in your lane thing, but we also want to say, don't take the risks. If you have some ideas that are in the business that you want to keep as a hobby or that you've always kind of done as a hobby, put that in a separate business ahead of time. If an expansion opportunity comes up that you're really excited about, maybe it's not the time to sell, or maybe you can carve out that piece out of the sale. Again, that's between your business broker, your lawyer, and the buyer to figure out what exactly they're buying. Or better yet, don't include that in the business. If you think you're on a 2 to 3 year horizon, set that up as a side entity that's not being sold.
Totally agree. So you've set it up, you made the decision. Now we're in the process, and the next thing we want to talk about is when you're entering due diligence. If I can get the screen to go forward here. Whoops. So let's talk about the due diligence process and what I call surviving the due diligence process. For those of you who've never been through the process, it's not very fun, but it's a necessary point where the buyer of the business has the right to go through the business and make sure they're getting what they believe they are getting. And so, Jeff, you want to tackle this slide here?
Sure. So we've numbered them to make it easy, but they're in no particular order. All of them are important, obviously, depending on the type of engagement. And certainly some of this stuff isn't stuff that we would do. Maybe other people or other professionals are better suited to doing this, and maybe including the buyer himself or the buyer herself or the buyer's team. But step one would be to analyze the quality of the revenue. What kind of sources, where's it coming from, what customers. If you have customers that are if the business you're buying has customers in a really stressed industry, consider how likely they are to continue that line of buying patterns. Look at margins by department, by location, by industry on the business you're buying. Per the previous slide, trends are important. Take out one-off non-recurring work. What is more enticing? It's kind of a rhetorical question for Adam, because I think I know the answer. What's more appetizing and enticing in a business? One that has very high level of recurring revenue, or one that is mainly project driven, that they have to reinvent themselves?
Recurring,
it's going to be a recurring revenue business. Next, we're going to look at who our competitors are. How do we stack up against them? What threats do we pose? Where do we overlap? So your typical SWOT analysis, right? Strengths, weaknesses, opportunities, and threats. The same thing, you want to do that same analysis with the customers and with the vendors. Are the customers loyal to the owner? Are the vendors loyal to the owner? Are the vendors kind of, had it up to here. I'm not going to give the sign, but, doing that with the business because they've been slow paid for months, and it's just maybe bad timing. You buy in and 2 or 3 key vendors leave, and now you're begging them to come back, and maybe you have to make some kind of amends to get them to come back. That's going to hurt cash flow. So look at all that. What's the competition, and what is the situation like with the people that are key to the business, and compete against the business. Third, we're getting in more into a little bit more of the goodwill, but what makes us different? I've heard a saying from a business coach that the riches are in the niches, and developing an understanding of any processes that are key or give an advantage. What makes our business unique? Do we have areas that we can exploit to our advantage? Maybe there's an area, a high margin area in the business that has not been exploited. Maybe the owner's selling, and a son or daughter or a younger associate, younger lieutenant in the business is really gung-ho, and they're going to stick around. And they have some great ideas. Maybe you want to listen to them and see what they're doing. Those are areas that you might be able to get a very quick return on your investment and beat some of the forecasts that you were looking for. If it's more of a stoic business that has this opportunity that can differentiate themselves or come up with a very high margin offering. I just segued into it with a key lieutenant or people in the business. People do business with people. Bankers leave, and within a couple of years, all the clients that were at Bank A, a lot of them probably have migrated to follow their banker at Bank B. So be sure when you're doing your due diligence to know where allegiances lie. The owner, or does the team and staff hold enough sway to maintain that? Are they loyal to the business, to the logo, or they're loyal to the people? If you buy a business, you make a bunch of changes, and some key sales folks leave, or some key superintendents or operations managers type folks, if they leave, are you going to be able to deliver on those orders that you were able to keep? That's something you need to evaluate. Notice that the last few things that we've said have nothing to do with true accounting, dollars and cents, debits and credits. A lot of it's more of doing your due diligence on the business as a whole and the operations. Let's get back to the numbers though, since I am an accountant. Let's review the balance sheet for accuracy. How long does it take for our customers to pay us? What's the quality of that? How long does it take for us, the business we're buying, to pay our existing vendors? I mentioned before, what are those vendor relationships like? What are the quality of the assets that are being transferred? Typically, most purchases are an asset sale, but you're buying the equipment, the rolling stock. What is the age, the condition? Has it been maintained? Was it a quality piece, or do they buy the knockoff brand? The name brand piece of equipment, or they buy the competitor, the cheaper competitor? What are the debt levels? Even if it's an asset sale, that can give you a clue of kind of how things are being maintained. Was the business really struggling with cash flow, and what was the extra cash being used for? Stripped out of the business or reinvested? And then lastly, the last two things, risk and threats and kind of expectations. I'm going to roll those together. Are there big changes coming to the micro and macro economy, or the micro and macro markets? Think critically. Are we buying a Blockbuster or a Netflix in 2007? We probably have a subscription to one of those at home, and the other one is a distant memory. Critically review the forecast like we talked about. Review the profit estimates. Make sure they're grounded in reality. Are there any new products and services on the horizon? I talked about that earlier as well in this slide. Are there things that we can leverage to our advantage to get a quick return on that investment? And then what is the impact if those new opportunities don't work out? I talked about pulling those out of the business if you're the seller, but if you're the buyer and you're gung-ho on those new opportunities and they are included in the sale, make sure you look at the downside and see, okay, what is my realistic cash outlay and time to get this to market to where it's break even, so I'm not funding it, and then to where it's profitable and giving me a return not only on that investment, but the investment I'm making on this business as a whole right now if I do complete this transaction.
Jeff, that is a phenomenal list. A couple things I just want to say that come to mind. A lot of people, when they review their financials, as you suggest, they just focus on the P&L, and they don't always focus on the balance sheet. And trust me, buyers and lenders are going to be looking at that balance sheet. There's a lot of clues as to what's going on in the business. So make sure you look at your balance sheet as well. We recently wrote about it in one of our newsletters that number 4, due diligence on employees and management has become the top issue in deals today. It is so important in a tough labor market that people want to understand the team that they are inheriting when they buy them. So, what we tell people when they're going into the due diligence process is take off your owner hat and put on a hat that says buyer. Look at your business critically before you're getting ready to go. Clean up the things, as Jeff mentioned, clean up your office, clean up your inventory, clean up your financials, clean up things that need to be cleaned up. Because if you don't think a buyer is going to find the one thing you didn't clean up, you're wrong. They will find it. So they have advisors on their side. They have lenders. They have CPAs, attorneys. They will find your weak spots, and that's okay. But just be prepared to talk about it and be prepared to say, well, it's a lot better than it was 2 years ago. We've made these changes, and go on offense about your weaknesses, because the due diligence process can be, we say, a bit invasive, but it's necessary for a buyer to feel confident and a lender to feel confident that the deal is going to be amenable for all parties involved. I want to go on to the next slide here, but I think I know what it is. It's the question slide. We don't have any questions. I'm going to make a final appeal for any questions. You can put it in the Q&A or in the chat if you're interested. We'll give people 30 seconds or not. But if not, we also want to be respectful of times. Last call for any Q&A. I don't see any. We want to thank everybody for their time. Here's the contact information. If you have any questions, want to follow up on a point that primarily Jeff spoke about, all of his contact information is right here. Obviously, mine is as well. We will send the link out to everybody who attended this. So if you're, if you want to watch one segment again about due diligence or the 3% model that Jeff did, we'll send you that link so you can watch it again. And we want to just thank you. We are taking the month of December off. I'm going to let people be with their family and holidays and employees, etc. But we have a super exciting agenda of webinars to kick off next year. So look in your email for future invitations for more of these. So Jeff, really want to thank you for your time. Thank you everybody who watched this live, and for those of you who watched it on replay in the future. Thank you all, and if you have any questions, we'd be happy to help you. Thank you. Thank you, Jeff.
Thank you, Adam.